In this one, I have 5 different ETFs that are all focused on growth, either growth stocks or growth areas, growth sectors. So no value plays, no dividend stocks really, although some of them do pay dividends, but growth areas, tech, healthcare, that sort of thing. Let's get stuck in with the first one, which is VUG. This is the Vanguard Growth ETF, which is basically the growth companies within the S&P 500. So all of those names that haven't really performed very well this year for various reasons, financials, things like that, not in this ETF in really any big numbers, focusing on what has coincidentally been the best performing areas in the S&P 500 this year. So you've got tech, healthcare, so Apple, Amazon, Facebook, making up large proportions of this ETF. In VUG, the S&P 500 Growth ETF from Vanguard, tech makes up 43% of the portfolio, which is massive. So obviously with those big names, especially Apple appreciating so much this year. I mean, Apple's gone from a 1 trillion to a 2 trillion market cap company really quickly over the last 12 months or so. So having those names as the biggest percent of the portfolio obviously has meant that this fund, the VUG ETF, really has performed well. So you've got Microsoft, Amazon, Facebook, Home Depot even, Nvidia and PayPal, which have all just performed incredibly well this year. They are really the stars of the stock market this year, and they all are in the top 10 in terms of holdings of this ETF. Now, the returns for this ETF are really outstanding and totally has outperformed the wider S&P 500. So you have a 25% return for the year, an 18% return over 3 years, 14% return over 5 years. Now, with investing in this, you may say to yourself, well, is there any further for these tech names to run? They're maybe already very overvalued. They have very high valuations. Will they continue to do that? That's a question you have to ask yourself. Of course, we don't know what's going to happen in the future. But with this ETF anyway, you are pretty much getting the best names in the S&P 500, with some of the laggards just being left out. Now, in terms of the expense ratio of this ETF, it is 0.04%. So for every 10,000 you invest per year, you pay $4 per year for that. It's a really low expense ratio. There are lower ones, 0.03%, for example, for the S&P index tracker. But in terms of expense ratios, it's very good. And then we move on to the iShares Russell 1000 index trackers. And I've actually got 2 here. One is IWF, which is from iShares, and one is VONG from Vanguard. So they're both essentially trying to track an index of the Russell 1000, which is the biggest 1000 companies, although they're not exactly the same. Some of the holdings are swapped around, so the weightings are a little bit different between iShares and Vanguard, but more or less they do track the same thing, and actually the returns that they've both had are pretty much the same. So the iShares tracker has returned 22% this year, 18% over 3 years. The expense ratio on that one is 0.19%. So getting towards the more expensive side, whereas on the Vanguard, you have a similar return, 23% over this year, 18% over 3 years. So in terms of percentage returns, the two are almost identical, but the expense ratio on the Vanguard is actually way lower than the iShares, 0.08% expense ratio. So actually more than half that you're paying for the Vanguard as opposed to the iShares, which over time may influence your decision on which one to go for. One of the biggest differences I noticed between the iShares and the Vanguard ETFs, even though they're both called Russell 1000 index trackers, is that actually in the iShares account, Tesla is in the top 10 of its holdings. And in the Vanguard, it is just at number 12. Now, this again, obviously, if you look at the total returns of both of these indexes, then there's nothing in it. So even though the weightings are slightly different, overall, I think you're getting more or less the same exposure. In terms of sector specific, the iShares self-driving EV and tech ETF definitely is specific. So this is focusing on a lot of companies, all really to do with electric vehicles and the tech around electric vehicles. When you narrow down in terms of theme and sector, risk goes up, and so expected reward also has to go up, at least the volatility of the index compared to the benchmark, which would be the S&P 500. So this one actually trades at around about $33 per share of the ETF. This year up about 22%. The expense ratio is 0.47%. So the more niche that you get with ETFs, the higher the expense ratio usually is. As this ETF focuses on electric vehicles, I'm sure we can all guess what the main holding is. Tesla, obviously. But surprisingly, Apple is actually number 2. And that's really because, well, the tech portion, and also Apple does have a lot of investments in a lot of different companies and definitely has a stake in terms of electric vehicles and technology in general. Then comes some chip makers like Nvidia, AMD's also in here as well, and Qualcomm. You may think, why are chip makers in an EV ETF? Well, electric vehicles need chips. They're basically computers on wheels, and so chip makers definitely have a lot to gain from the EV space growing and getting bigger over time. Then in this ETF, you also just have a ton of just normal car makers like GM, Ford, Daimler, BMW, Hyundai, and a ton of others. Why are they in an electric vehicles ETF? Well, they are all making electric vehicles now, and the amount of EVs that they're going to be making in the future is also going to grow. So they really should be included in an ETF like this. What that also serves to do is really reduce the risk, because the EV space is very small right now, and basically you could just have Tesla in there and just not have anything else. So having chip makers and just normal automakers definitely reduces the risk and diversifies the ETF. You also get some up and coming names in this ETF as well, like NIO, which is a small brand in China, electric cars, really good company, really good cars overall. And also BYD, which is actually a huge company based in Shenzhen, and they make all of the taxis and the buses, the public transport. It's all electric in Shenzhen, and they make all of those. There's a lot of big names in here, and really the question on this one is, well, should you go for something like this, which is focused on electric vehicles and tech, or should you just put your money in VONG, the first ETF we mentioned, which is just the biggest companies, growth companies in the S&P 500, which also has a lot of these companies in. So Tesla and a lot of the chip makers, they're all in that growth ETF as well. So I guess it's a decision that, do you really need to actually have a EV focused ETF? Or can you get exposure to a lot of those companies, more general, just like an S&P growth ETF? Well, anyway, the year-to-date returns on both of these ETFs is pretty similar. So the iShares EV ETF returning about 22%, VONG, that Vanguard S&P growth ETF, returning about 25%. Then we come to the GlobalX Cloud Computing ETF, which I think is a really cool and really fundamentally a growth area to be in, and definitely does give you just something different, something that isn't the top 10 companies in America, which is Apple and Amazon, and something actually different that's going to diversify your portfolio. So the biggest holding in this ETF is Twillio, which is a company that helps businesses communicate with their customers either through WhatsApp or SMS or email. So everything under one roof, and then the company can use all these different communication tools and messaging apps to communicate directly with their customers. Another platform as a service company in the top 10 holdings is Shopify, which really enables small and medium-sized businesses to move online, having their own shops and also getting a lot of the sales data themselves. It also helps businesses market online and also move all of their in-store digital payments options online as well. So it's a really good company that helps SMEs, and it's also had a really good run in terms of the share price this year. Zoom is also included in this ETF, which is a software as a service business. As you know, that just blew up when everything was happening and everyone was locked down this year. And yeah, the share price has also done extremely well, which is why this particular ETF has completely and utterly blown the doors off in terms of the share price and the performance compared to pretty much anything else. It's up 44% this year, which is incredible considering that the ETF is quite diversified. It's not just one company that's done very well, but diversified over many more. Then we move on to the iShares Exponential Technologies ETF, and the ticker on this one is XT. And the main theme on this is just to invest in companies with new disruptive technologies that are or will replace existing technologies. So for example, you have Amazon in here, which has just changed the way that we shop, and that has disrupted the normal way that it used to be done before Amazon came around. They also have Mercado Libre, which is essentially the Amazon for South America, same thing, buying online. And they also have Alibaba, which is the Amazon of China. So they like that type of disruptive stock. They also have a lot of cloud and digital companies like Salesforce.com, again, moving everything online. And First Solar, again, solar energy definitely will disrupt things going forward in terms of the energy industry. Unlike the GlobalX Cloud portfolio, there are some big names in here. So there's not really a focus on small growth stocks, but just simply any technology or any business that has a technology that can disrupt the way things are done now. The expense ratio on this one is 0.47%, and there are actually almost 200 holdings in the ETF. It's returned 16% this year, which, considering it is really way more diversified than the cloud computing ETF, because there's no specific industry that it focuses on. So it is really quite diversified. You have a lot of different businesses in a lot of different sectors across the market. So the diversification is very good, but still a 16% return, which is even more impressive considering that Apple only makes up 0.7% of the index, which really is the culprit as to why so many ETFs have performed well this year. They also hold companies like the London Stock Exchange and NASDAQ, which are two exchanges that really are moving all the way towards digital. So again, just disrupting the old-fashioned way of doing things. And they even hold a company called Corning, who makes the Gorilla Glass that we use in smartphones. So yeah, it is very diversified, and I actually really like a lot of the businesses in that ETF. And yeah, certainly a lot of people, most of us, will just have an S&P 500 index tracker as the base of a portfolio. But something like that iShares ETF really does just give you some different names and some different companies and some different areas to invest in, rather than just going for something like VONG, the first one I mentioned, which, you know, if you have an S&P 500 index tracker, you're going to have all of those names in there more or less. So definitely when you niche down, that should be used as maybe a satellite to the main portfolio. But anyway, very interesting growth ETFs overall. As always, I'd love to know your thoughts on these ETFs, any others that I didn't mention and that you think are good, you're invested in or want to get invested in. That's it for now though. I hope you enjoyed the video. If you did, please give it a thumbs up, and I'll see you in the next one.